Good afternoon, ladies and gentlemen. Even before Robert commanded us to be happy, I was quite happy to be in your midst because for me, I think it's very important that we celebrate our achievements, that we celebrate success, and for each and every one of you who participates in this initiative, you have already succeeded. In particular, we saw some numbers from the research findings of the companies that were approached the first time around, 500 plus, but when it came to disclosing a little bit about the financials, by completing the financial questionnaire, those numbers went down by half. Now, for any of you who are here, it shows that you're willing to subject yourself to some level of scrutiny, you are willing to disclose some information, and that, believe it or not, is only possible if you overcome some considerable inbuilt barriers that we seem to have. So for all of you who are here, congratulations and all the best tomorrow. But it was also very gratifying to me to see that of the 247 participants this year, 24% would consider a listing or coming to the capital markets to finance their growth. Now, obviously, one of the requirements for participation in this top mid-sized companies competition is that you should not be listed. And so I also like what Robert said about Mr. Bata. For me, none of these companies are listed. I am in heaven. This is a gold mine for me. But even if just the 24% who have expressed an interest list, first of all, I think Linus's prayer will have been answered. Much shorter than the 5 years he had given us. So perhaps over 5 years we should target higher. 24% of 250 is probably something like 60 companies. You'll be aware that we now have 55 companies that are listed. And so from my perspective as the exchange, a potential increase of another 60 companies is a feat that would be very commendable, very good for this market, very good for our economy. We had some interesting discussions just before I came up with Humphrey, and God bless the banks. We all love them or hate them, but we all need them. Banks provide a very valuable service to all of us. They are vital for the development of any economy. Financial deepening is one of the things that holds back the continent. But at least for those of us who are in this room, access to financial services may not be the problem. I think the problem that the gentleman was highlighting is more about the affordability of it and the pricing of it. And clearly there are some concerns there. Our banks continue to charge a fairly huge spread when you compare what they pay for the deposits and what they charge you for the loans. But one of the key things that has happened at the exchange since last year, when we automated secondary trading of bonds, is we have seen a 3.5 times increase in the volumes of bonds traded in the secondary market. By the end of the year, we expect that the entire amount of government debt in issue will have been turned over at least once, up from, well, maybe 12% last year. Why is that important? That's important because it therefore means that any investors or savers with some money they want to park have options. If you now put your money in some government debt, you know for a fact that when you need to liquidate it, you can trade it in and get your cash on T+3, on the third day after that. So you are much better able to manage your treasury function at the existing bond rates for the longer end of the yield curve. What was the alternative before? You probably put it in a call account and have that discussion with your bank. Remember also that 56% of all this stock of domestic debt is being held by the bank. So they are taking your deposits and buying the same domestic debt. So if you are able to do that yourself, you get a better return on your short-term surplus cash. I think the point of that story is that the more choices you have, the better off you are. Now, on the funding side, when you need to raise funds for your own business, I would put it to you that you are better off having options. Right now, a lot of businesses, as we saw from the survey, are funded by the owner investing their own savings, their own cash into the business. They start it off. They probably get additional funds from friends, from family. Eventually, you graduate, and when you need to expand, you talk to your bank. I think time has now come for us as a capital market to also be responsive to the needs of the mid-sized companies in our economy. The banks have all responded. Every credible bank has an SME banking unit. What is the response of the capital markets? First of all, let me say that I think looking at the participation, a lot of companies qualify already for a listing on the main segment. You are as good as some of the companies that we already have listed, and there's no reason why you cannot become a listed company. Part of our reason for being involved in this initiative is to get closer to you, to engage with you, and to hopefully demonstrate to you that the exchange is not some far-removed alien game for different sorts of people. It really exists for businesses such as yourselves. The other thing that we will be doing is to come up with a market segment that is more responsive to the needs of SMEs, so that we are able to have an offering that has less stringent requirements, either for listing or for continuous obligations imposed on issuers than what exists in the main segment. I had prepared a couple of slides which I shall try and find at this moment. And my intention is not to walk you through the entire presentation, because I am very much aware I'm the only thing that stands between you and lunch. It's just to highlight a couple of things that I thought would be of interest to you, and because we are also planning an engagement with yourselves, hopefully next month, where we can delve more deeply into the issues around preparing your business for listing and so on. But clearly, you would expect this from me. I believe there's a very strong case for businesses such as yourselves to come to our capital markets, not just to access funding, but also for a whole raft of other benefits. We want to be a leading exchange on the continent. We are on our way, I suppose, to that position. We are currently one of the top performing markets on the continent. Our market has recovered from the problems we had a year or so ago. This year, the index is up 42%, market capitalization is up 30%, equity turnover is up over 100%. As I said, bond turnover is up over 250%. The index is now above 4,600. Historically, when the index gets to 5,000, we begin to see a lot more interest from issuers. So I'm hopeful by the end of this year, we will be approaching the 5,000 mark, which will make it that much more attractive for issuers who are keen on getting a good valuation when they come to market. We recognize, of course, that businesses go through phases, and the companies represented here are of different histories, different profiles, different maturity, and we would like to have offerings that respond to businesses at each of these crucial stages in their development. But at whatever stage you are, a listing makes sense because you would be able to access capital which is better priced, I think, from better than the options you currently have. Funding to finance your working capital requirements is one thing, but businesses also require long-term capital, they require patient capital, they require equity investors, and the capital markets are a good source of that kind of capital. Of course, then you will be able to generate some liquidity around the stocks in your company, but also enhance the profile of your business. Participation in the top 100 mid-sized companies has already done that by exposing a lot of your businesses through the media and to potential venture capital, private equity investors from around the continent and overseas. A listing also heightens the profile of your business and makes it that much more interesting to potential investors, to suppliers, to employees. So there are a whole host of other soft benefits to a listing. I think I can perhaps best illustrate what a listing can do to your business by taking an example from one of our issuers, Athi River Mining, which is a company which is well known to all of us, and share with you some highlights from their story. This is a company that was founded by the senior Praunrana. They came to the exchange in 1997. They had an IPO, and Pradeep Praunrana, the chief executive, tells me that when they opened the IPO, the day the IPO opened in 1997, they were actually running battles in the streets of Nairobi. You remember 1997 was an election year, a lot of political uncertainty. The economic climate was not looking very favorable. The market itself had been booming, but promptly went into a prolonged bear run. But even from such inauspicious beginnings, they've been able to grow over the years. They have been able to access financing from a variety of sources. I am not here to tell you that the exchange will be the only source of all the capital you'll ever need, but having a listing improves your credit standing, your credit worthiness, and makes your discussions with DFIs, with commercial banks, that much easier. Over that time, they have raised a substantial amount of money, but they have also been able to grow tremendously. And I think that is an interesting graph that shows their total assets, total revenue, and their profits from 1998 to 2009. All those figures starting at somewhere around 100 million, and now total revenue of 5 billion, total assets of 9 billion, earnings approaching $1 billion. So in a sense, when they came to market, they would have been a prime example of a typical top 100 company. 100 million in turnover, 100 million in assets. Fast forward a decade later, and you can see the kind of growth that they have been able to generate. Turnover increased from 78 million to 5.1 billion. Their profit margins have expanded, but their profitability has also grown. Profits actually increased from 9.5 million to 948 million. I think this is a real example of a Kenyan company and what they have been able to achieve over the last decade or so, starting from a situation pretty much like where most of you are, and starting off at a time which was much less confidence-inspiring. than the circumstances we are in today. Previous speakers have alluded to the regional integration, the acceleration of GDP growth, the opening up of greater and greater opportunities for our businesses. So actually, we are taking off from a much better time. And I think this is one of the things that gives me a lot of confidence to face the future, that we are starting off at a time which is a lot better than the people who've gone before us did. And if ARM could do it, there's no reason why any of us in this room cannot do so. I think I've mentioned the figures for turnover, and the kind of profile that they have in the press, but not just the press, but also coverage from analysts, their engagement with investors, all of which builds their profile, attracts foreign investment. Athi River Mining has been a very active counter with foreign investors over the last year or so. If you are able to get in front of investors, share your story with the analysts, it improves price discovery on your counter. We believe that mid-sized companies which have demonstrated their ability to grow, to do so profitably. We've seen returns on equity which are out of this world. You are innovative, you are seeing opportunities in the region, you are creating jobs, is the future of this country. The exchange would like to be a part of this unfolding story. We would like to be there for you, to support you, and avail to you the capital which we know is there. If you see the kind of primary market activity that we've seen over the last year or so, all of them oversubscribed, because the money is out there looking for an investment destination. Your businesses would be very, very attractive from an investment point of view. How do you do this? We can have a discussion about eligibility criteria, which basically are centered around CMA regulations for the initial listing and our own requirements that you continue to comply, fairly technical in nature. A lot of your businesses already comply. Our intention is to have an offering that does not impose an extra onerous burden on you. You already prepare management accounts, you prepare audited accounts for running your own business. We should be able to take that information and work with it to safeguard the interests of investors and to share it with the market. So to the extent that you are willing to spend the time year after year to participate in this exercise and provide that kind of information, we are almost there. The requirements, I'd like to demystify perhaps any expectations that listing imposes onerous obligations. I think Linus will tell you that it doesn't. It's a good thing to be. The concern about how long the process takes, we've had the market players. The last bond issue of housing finance was approved within 3 weeks in terms of the cost. There are options as to how you can manage it. You don't have to have a full-blown nationwide IPO like a privatization. You don't have to end up with a register of 100,000 shareholders. All this can be tailored to the needs of the particular issuer. And with that, ladies and gentlemen, I would like to thank you once again for participating and to reassure you that the exchange exists to give you an option, in particular an option to source funding to meet the long-term requirements of your business. Thank you.
Anybody with a question? Aha, there's one here. Introduce yourself and then your question.
My name is Priyesh Shah from Kenya Sweets Limited. We make these tropical mints that you're eating at your table. I just wanted to ask, I think it's a confusing issue. Most SMEs pump profits back into the business to grow them. So if you were to issue shares and there were no dividends to share out with the shareholders. Wouldn't that be a misnomer?
Yes, dividend policy is a big issue for investors. But even among our currently listed companies, there are some companies which have a stated policy of reinvesting all their earnings and not paying out a dividend. I'll give you a specific example of Centum Investments, a company which I know fairly well. I spent a number of years there. Their current policy is that they will not pay out any dividend because they see very good opportunities to reinvest. And what has happened since they made public that particular policy, their share price has gone up from around 13 shillings to the current 24. So we are getting more and more sophisticated investors. As I'm sure you know, Warren Buffett and Berkshire Hathaway don't pay a dividend. What's their current share price? Almost $100,000 per Class A share. So you will have investors who understand your story, who are looking for capital appreciation, because in particular in this market, capital gains are not taxed. So they're actually better than a dividend. And for a number of investors, the capital gains are the driver of the decision more than any dividend yield on an ongoing basis. So yes, it could deter some investors, but there will still be enough investors who buy into your story, who love Tropico, and who will invest.
Hi, Rupen from Furniture International. A lot of the modern Western markets, they've got another capital, let's say AIM or something like that. And essentially what that does is it's got less onerous requirements. And if you think of a lot of these SMEs, you know, they don't necessarily have the corporate governance structures or, you know, policies in place which will enable them to be a listed company. Mm-hmm. So do NSC have a sort of platform in mind such that it'll enable a less onerous requirements and yet enable SMEs to raise capital?
Thanks, that's an excellent question. We have looked at the AIMS market in London, we've looked at Alltex in Joburg, we've looked at these sorts of alternative markets in Mauritius and elsewhere, and we've developed, as I speak, between ourselves and the regulator, Capital Markets Authority, some framework of a segment that we can introduce with exactly what you describe. Less onerous requirements on an ongoing basis and also more flexibility in allowing you to list. And we hope that this will be unveiled within the next 12 months. It takes a bit of time to put it together, get the regulations in place. We are working on it. Certainly within the next 12 months, we should have something in place. Let me also say that you don't have to confine your options to an equity listing. You can also access capital from our debt markets. You don't have to be listed to do that. And if you are listed, you don't have to issue listed debt. I mean, there's lots of flexibility. And as I said earlier, a lot of the companies in this room, I hesitate to call them SMEs because they already meet the criteria for a listing on the main board anyway. And even that is not so onerous as to frighten you away. It's something I think that you should engage with. We can have a conversation, we can have a facilitation that gets you there, and you begin to reap the benefits, including the tax incentives that government has provided. You'll know that there's a tax amnesty when you list, there's a lower corporate tax rate, and the 3 sets of books can merge into one. You might, I don't know what, I know all the people in this room are good people. That won't affect too much your cash flows, but in terms of the multiple that you are then able to realize for your business, it goes up. I think the multiple for ARM, as we saw, is something like 17 times earning. If you try and sell your business now in the private market, what multiple are you going to get? 5 times earning? Maybe 10 times earning? In the public markets, you can get 20 times earnings. It more than compensates for whatever tax adjustments need to be made.
Mr. Mwangi, there is a system of rating of private bonds in more mature markets. If you could share with us, is there, now that credit referencing is beginning to gain some ground in the commercial banking sector, is there any steps being taken where, from an investor perspective, that an investor can just very quickly look at Standard & Poor's? Is it a AAA? Is it a BBC? Is it a junk bond? Is there any mechanism that, maybe not the stock exchange, but as the regulators, capital markets, and is there a process that has either begun or is on the drawing board at some point, as the amount of debt being available and being easily tradable, to give investors an indication of what their risk portfolio is?
Thank you. That's an issue that we are grappling with. As I said, we've had some resurgence in our bond markets. And when we compare ourselves and we benchmark against more developed markets, we were some way behind. We've started putting in some of the prerequisites to a well-functioning bond market. We've automated the bond market itself. We've introduced a yield curve. There was no yield curve. We are issuing now, government through CBK is trying to consolidate the issues around benchmark bonds. And then we want to introduce market makers in the market and primary dealers and so on and so forth. And part of this whole effort will also be towards moving towards rating the instruments themselves. Because as it is now, whether it's Safaricom that's issuing the bond, or it's Kengen, or it's government, there's no categorization by credit of the issuer. So a fairly good credit will still have to pay quite a high coupon to attract investors. And we need credit rating so that, A, the investor knows what kind of paper they're buying, and B, a good credit issuer gets good rates in the market which reflect the risk of your lending to them. So we are at an early stage, but there are efforts to develop the market towards that end. You will have seen, for example, that approvals have been given for the IFC to issue a local currency bond. And the whole point of the IFC raising funds in the local market is not because they need to access capital from this market, so much as they want to propel along this process of development by introducing issues that push the envelope. So yes, it's a concern. The credit rating agencies are there. We need to get to a place where that's a more widespread culture, and the first point of reference for investors is what's the credit rating of this instrument, what's the credit rating of the issuer, which makes you as an issuer with good credit standing access the market at lower rates. Thank you very much, ladies and gentlemen.